Hey folks, Dan Bird here on Friday, the 14th of November, and not again. So last week I opened this up by saying this hasn't happened since the bottom in April. This is I'm going to show you this chart here in a second, but this is a weekly chart. So we'll look at that in a second. I'm not a financial advisor, so this is all for educational purposes only. Let's take a look at that chart. I'll show you what I mean. So last Friday, when I did the video, we were below the 8 EMA. This is a weekly chart. So this is an 8-week exponential moving average, the pink line right here. And let's see if I can make that a little bit bigger. There you go. And I said at the time that if we were to close by the end of the day on Friday, below that, it would basically be the first time since way back here near the recovery from the bottom back in April. So what happened? The end of the day, after I did the video, the end of the day, the market zoomed higher and closed above it. So we did not end up below the 8 EMA like we did back in April. But look what happened today. This morning looked pretty scary, didn't it? Market was down significantly. We'll look at the 10-minute charts here in a second, and it will become very clear. But look where we are now. It's again back above that 8 EMA. Now, this is a typical consolidation movement and perhaps even distribution. I've talked about this before, looking at the Wyckoff market cycles, distribution after a big markup period like we've had since April. Distribution means we just go sideways. We struggle to try to make new highs, and eventually we break through the bottom and go back down through a markdown period. But that could take a while. That could take a couple of months, 2 or 3 months, in fact, like it did in the beginning of this year. I was talking about the same cycle back in November of last year. And it was like that. It went sideways November, December, January, and then February finally broke. And we had this big downtrend back here. Actually, you can see it right back here. So here's the consolidation right through here. Here's December, basically right through this period. In fact, I'll draw a Darvis box around that. Basically right through this period right here. There's your Darvis box. And here's the breakdown right here, the end of February. So we got a red bar in February, went below the 8 EMA. It actually went below it on this red bar as well. But basically the market was just moving sideways, much like we are doing right now. So if I take the same Darvis box and move it up here, we've only just begun, of course. So this one we'll put right about there. So that's what we're looking at. 65.50 at the bottom. 66.50 will be really important as well. That's the bottom of these lows right here. But that is the box that we're in. That is the sideways channel. And if we are going to stay true to the Wyckoff market process, then we will probably be going sideways in this box for a while, maybe even through the end of the year. We could break out through the top a little bit. Probably we'll hit 7,000, which is up near the top of the box, a little bit above it. Nice round number. And I think there's lots of sellers positioned at 7,000. Now, I've been saying for months that 7,000 is where we're headed to. So I think once we get there, there will be lots of sellers. There's sellers going on right now, I think, right through this period. But again, today we went below that 8 EMA, and right now we're above it. So it's really important to see how we close today. If we close below that, then we will have done something that has not happened since the bottom. So keep an eye on that level. Now let's see where we actually are. Look at the charts on the charts page and look at the 10-minute charts. And we'll probably see a big gap down today. Yep, big gap down right there. I haven't clean this up today, but there's the gap down right here. And right from the beginning, right, we opened here, we went all the way down here to 66.50. Interestingly, 66.50 is a pretty important number. You'll notice that was the bottom, close to the bottom back here in November, which is only last week, basically. So that's the bottom from last week. Didn't quite get that low, but touched there and then started going higher. And we've been continuing to go higher ever since. So the key today is, will we close higher or will we reverse and start to go back down and go below that key level from the weekly? So this level that we're watching is right here, 66.50. We went down and basically just touched it today. But if we end up closing below that, or even closing below about 6,700, which will be below the 8 EMA, anywhere in that neighborhood, anything below 6,700 will be very negative for the markets. So keep an eye on that. Technology is coming back. Discretionary and communications in particular, is dropping rapidly. On the defensive sectors, they're starting to move down. So the rotation is back into technology. Staples, utilities, and real estate, both going lower, and the cyclical sectors also moving lower. Financials, healthcare, industrials, materials, energy is the only one that's perking up, moving a little bit higher. Rotation, growth versus value, is starting to make a comeback, but it's got a long way to go to get back up to where it was. Discretionary versus staples, small comeback. Technology, you can see right there, that's where things are moving back into semiconductors, and transports are fairly flat for today. There's the breadth. You can see percentage of stocks above their 20 and 50 are back below the 50% level. So that is not a good sign. And they haven't really moved back above it, even with the recovery this morning. So again, I'm not convinced that there's a lot of conviction in this recovery from this morning. I think that's a lot of the buy the dippers buying back in at these same levels where we went down to, thinking it's going to do exactly the same thing. And it very well might. In fact, it might continue to do this exact same thing for a few more weeks or a couple of months. This is where traders, the big traders, love to sell into strength, sell to retail buyers, and that's why it's called distribution. So if this is making a distribution level, then that's what you're going to see. You'll see a big sell-off and then buy the dippers stepping in to buy. There's the Russell, same thing. Gap down this morning, moving up right now. Money flow is trying to make a comeback, coming back up. Versus the S&P, a little bit of strength, but the S&P still looks stronger. Certainly looks stronger with mid and small caps for sure. So the S&P is still looking better. Russell 2000 does not look like the best place to be. There's breadth for the Russell, also below the 20 and the 50 and the 200 now, interestingly. So that's the 50% level on each one of these. Percentage of stocks below the 200 is at about 49%. And that's the small caps, which looks the same. Here's the NASDAQ 100. This is where money should be moving to. So this one should look stronger. Money flow looks pretty positive right now, but this is definitely moving up. So we'll see if that continues to the end of the day. The black line is advancers minus decliners. So there's more advancers. That's good. Up volume minus down volume is just back to zero. So there's not a lot of conviction in this move. And the VIX is, while it came down in the morning, it's actually looks like it might be starting to level off here right at 20. So that's going to be an important level to keep an eye on too, that 20 level. Here's breadth for the NASDAQ 100. And interestingly, this one is continuing to go down. So percentage of stocks above the 20, 50, and 200 and the bullish percent index are continuing to move lower. Percentage above the 200 is only 52. So 52 out of the 100 stocks are above their 200-day. And 41 out of 100 stocks are above their 50-day. And only 32 out of 100 stocks are above their 20-day. So breadth is still looking pretty negative. So there's not a lot of conviction in this move. I am not convinced that it's going to stay above that 8 EMA, but this is really what we have to watch by the end of the day. It's already starting to come down a little bit. So keep an eye on this and see where we end the day. This is our distribution level right here. I'm going to leave this box on here. That is our distribution level for the S&P. Now let's go over here, and I want to go through some of these other charts over here on the charts page. So this is a rotation. This is more of a daily zoomed out view. So you can see up here the RSI continuing to move lower. S&P down now below its 21 EMA. There's discretionary versus staples. Had a nice run higher. Now it's moving back down, sitting right on this support line. Equal weight versus equal weight staples, discretionary versus staples. Also moving down. It's been moving down for a longer period. So this is where you can see discretionary is basically Amazon and Tesla. And both of those will help push that up because it's cap weighted. On the equal weight side, everyone's weighted the same. So it's actually been moving down earlier than that. Growth versus value is now moving lower. Transports moving lower. And this is the S&P cap weighted versus equal weight. That's moving down as well. So all of that indicates rotation, perhaps the market preparing for an extended downtrend, but we could be consolidating and distributing for quite a period of time up here. Just like we did back here in the beginning of the year, from basically December until February, we just kind of went sideways in this box and then finally broke down. I think that might be what's happening again. But this could, like I said, this could continue for a couple more months. And we could easily go up and hit 7,000 and then have it all start to roll over. So we'll see what happens. All right, let's continue down here. I want to look at breadth. So here's breadth analysis. Right here, advanced decline line. This is the NASDAQ 100. It's been pretty flat ever since August, sitting right on the moving average. That's a 50-day moving average. New York Stock Exchange advanced decline lines below the 50. S&P large cap advanced decline. That one's moving sideways as well. None of these are really breaking down yet, though. Mid cap is definitely going down and small cap's going down. So those look like the weaker areas. But overall, the market really hasn't given us a signal that it's really falling apart. Let's look at the bullish percent index. And these are the percentage of stocks that have bullish configurations. So you can see up here the S&P is the colored bars and the NASDAQ 100 is the gray. You can see both of them have kind of rolled over and making a lower high. So that is the definition of a downtrend, especially if it makes another lower low. So that's what we'll watch for next. But bullish percent index on the S&P definitely headed lower. And you can see right here, actually, that hasn't really changed much, even as the market rebounds. And on the NASDAQ 100, it's continuing to go down. In fact, it's accelerating to the downside. So they're both below the 50% level right now. Not a good sign. So that's the bullish percent. That one looks negative. I've been kind of talking about this, laying the foundation for all of this for a couple of weeks now, saying that it looked like breadth was collapsing. Here is the McClellan oscillator. I'll do it for the NASDAQ. This is the moving average of the advanced decline lines, and it's clearly below zero right now. Again, the NASDAQ 100 went down in the beginning and pulling back up. There's the bullish percent index. So all of that looks negative. Let's look at put call ratio, 5-day put call ratio. That probably should be going up, and it is. So more and more people are buying puts. Everyone's getting nervous. There's the VIX. The VIX actually is flat today, sitting right on the 20 line. VIX rate of change has started to come down. Now it's starting to move back up again. This is one thing you can do either the end of the day or on the weekend. I also like to look at the risk on, risk off chart right here. And this basically shows you as the S&P is kind of flat, pulling back slightly up here. You can see the RSI. That is a negative divergence, bearish divergence. And here's what big traders, how they're positioned. Junk bonds versus 20-year treasuries. If it is risk on, if they believe the market is going to go higher, then they are okay going into junk bonds. If they think the market is getting ready to go lower, they will move out of the junk bonds and into 20-year treasuries. And that's what's happening right now. Down here is junk bonds versus high yield corporate bonds, the same thing. And here's high yield corporate bonds versus 7 to 10-year treasuries, same thing. They're all heading slightly lower, meaning it's a risk-off environment. And here's the growth versus value, which I showed before, and discretionary versus staples, both of those heading lower as well. All of that implies rotation out of growth areas and into value areas. We can look at the price to earnings ratio as well. I haven't looked at this in a while. Here's the S&P PE 20, 15, and 10. So it shows you how elevated the PEs are. So there's the S&P. Here's PE of 30, right? This dashed line right here. So we actually went above that, went quite a bit above it from the last peak back here in December of 24, and now starting to come back down. But earnings have been pretty strong. So overall, earnings continue to go up. That's what drives the market, is earnings. If we look at the high-low charts, looking at it for the NASDAQ, you can see down here is the NASDAQ 100. New lows are starting to pick up. New highs are starting to go down. They peaked right here at the end of October, and now they're moving lower. And you can see here, this is new highs minus new lows. It is negative right now. So there are more new lows than there are new highs right at this particular point. This is just a way to look at sentiment to see what's going on. Here's the 50 and 200 moving average. So there's the put call ratio clearly moving higher. So that's bearish. Here's percentage of NASDAQ 100 stocks above the 20-day, 50-day, and 200-day. Gives you a wider view of it. And bullish percent index is now all the way down here. It's at 36. It got all the way down here to 30 back in April, the end of April. So it's getting close to, let me go back a little further. Yeah, right here, this was the low. So when all of these things hit way, way down, like they did right here, that's when we can start looking for opportunities to get in. They're not there yet. They are continuing to move lower, which shows weakness, but they are not at a low yet. So that's what we'd like to see. In fact, the percentage of stocks above their 20-day moving average back here on April the 7th was 0. There were no stocks above their 20-day. Of all of the 100 stocks in the NASDAQ 100, none of them were above their 20-day moving average back here in April, right around April 8th. And that is where the bottom happened, right there. So that's what we're looking for. We're not there yet. We actually have a ways to go, even though it is definitely showing weakness. We still have a ways to go before we can say that there's a bottom. What else over here? Bullish percent, we talked about that. Let's look at the trend analysis for the NASDAQ 100. This shows you basically the trends. So you can see now the medium trend is now below 0. So we have a negative medium trend on the NASDAQ 100, even though the long-term trend is still pretty solid. And really that won't roll over. You can see where it rolled over back here. This is back in February when it went below. It did that much earlier, around the middle of February for the medium term, and then took till the last week of February before that long term went over. We just did so on the medium term. So take that for what you will. It could be an early signal, perhaps, but the long term is still holding in there. But right now, everything looks pretty weak. It's really important to see how things close the day today. That's super important today. All right, so all of these things are on the daily routine. You can look at any of these Keltner charts, see how extreme we are. You can see we got to an extreme right up here, back here in the end of October, hit the 3x average true range, 3x ATR. And usually when that happens, you get a reversion to the mean. The mean is the 21-day EMA. That's what we did. We reverted to the mean. We bounced back up. We bounced back down. We're going back up again. And we likely are going to bounce around here for a while. So watch out. We've got red bars today too. Even though it pulled back up, it's not as bad as it looked in the morning. So that's what things look like. Let's go back and take a look at where we are. Still pretty steady. There's the Russell kind of going sideways, and the S&P also kind of going sideways right now. It's basically it's 12 noon right now on the East Coast. So keep an eye on this. Looks like it still wants to go higher after a big sell-off. So there's the buy the dip folks stepping in and buying down here. That'll prop the market up, and that could continue for a while. So keep an eye on this and see how we end the day. That's going to be the most important thing. Most important thing is, how does this chart look at the end of the day? Will we close below the 8 EMA, which has not happened since April? If we do, be very careful. And for those following the market timing strategy, I can look at that real quick. This gets updated every day. So it's still in a long position on both the medium term and the long term. Long term is really the strategy. So the goal is to, like a 401k, or just to keep your money in for as long as possible, hopefully for a year, to take advantage of long-term capital gains. This started in May the 5th. So it confirmed, even though the bottom was April the 8th was the bottom, April 7th, it confirmed about 3 weeks later. So right now it's up 19%. You can see the medium term is actually down slightly, but it has not flipped over to cash yet. So if we look at the weekly chart, and I can show you when that, today is important because Friday is the close of the week. So again, you can see we went below the 8 EMA, and then right now we're above it. So we'll see if we stay there and close above it. But it actually has to come down below the 21 before a go to cash signal is generated, and that's at about 319. Right now it's at 331. So we could, there's still room to come down and then turn around and go back up again. That's the whole idea of the long-term trend. It is not close to a signal. By the way, this orange arrow is Turner Capital. This is kind of what they do for their clients. This is their exit right there, 322 right now. So it's a little higher than my exit. Mine's at 319, but pretty close. And then if we go back and look at the daily, which will give you more whipsaws, but it will get you out sooner as well. And for the daily, you see here's Turner's exit 322, but the exit on this one is first off the 21, which is below the 21 right now. But the second component is the chandelier exit, which is this dash line right here. Chandelier exit is at 328, basically. Right now we're at 331. So this has to close below 328 for the medium term to give a cash signal, just like it did back here, right there. So it has to close below that to get a cash signal. So those might happen today. Keep an eye on it. If it does, I'll watch this around 3:30. If I see that it looks like it's going to close down there and give a cash signal, I will send an email out to all subscribers, let them know that that's about to happen. We're still quite a ways away, though, on the long-term signal. I don't think that's going to happen today. This one could still come down quite a bit and then turn around and go back up. So keep an eye on it. All right, that's it for today. Thanks for watching. Actually, let's look at the dashboard real quick. So there you can see the Dow is negative. The others are positive, though. NASDAQ 100 is higher. S&P 500 is higher. 10-year is up a little bit. Commodities, gold is down today. Crypto, Bitcoin is down 2,600, down to 97,000. Remember that 99,000 I talked about? Well, we're now below the 99,000 level. So if it stays there and continues to go down, I think we're probably going first to 90 and then to 80,000. Over here, it's large cap growth is the strongest area today. Small cap growth is the weakest. Nope, mid cap. Mid cap value is the weakest today. Energy is the number one, and technology is number two for sectors. And then we've got staples and communications. So there's a real mix today of different sectors that are leading. Palo Alto reports on the 17th. That's Monday. And then down here, this one here, this AVDL is interesting. They probably had, they might have been a buyout. I'm not sure what happened with that one, but that one went up significantly. And a lot of them look like this. They look like BE. If you'll notice this, I'll bring this up. A lot of stocks today look like this one. Open way down here and almost immediately started buying, going all the way back up. So it opened below the 50-day and now it's sitting right below the 21. Lots of stocks look just like that today. So that's implying that there's a big rally going on. Buy the dip is coming back in, but we'll see how long it lasts. Here's Netflix is at the bottom. Netflix is selling off right now. What else is at the bottom? BMNR, someone asked about that. That's going down. UNH going down pretty big today. Open Door, it's heading lower. Disney, they reported yesterday, missed, they're heading lower. Nebius Group, a data center company, they're going lower. American Express, silver is heading lower. In fact, let's just out of curiosity, I want to look at gold and silver. I could be doing this all day, by the way. Here's gold. Gold, while it started a really nice run, it with the rest of the market sold off and now trying to make a comeback, but well below yesterday's close. So that's not a good look if it stays down there. Gold and silver both. Silver is right here. There's what silver looks like, very similar to gold. Interestingly, things like some of the commodities like soybeans. Soybeans has had a great run and continuing its run. So these commodities are where the action seems to be. Here's corn. Corn, big move up today. You can see all of these over here. Whenever they switch over, they'll get a green bar here in the short term level. Corn, soybeans, lumber, which is important for the construction industry. Lumber had been going down significantly. It had a huge bounce today. So commodities are moving up today. Commodities are really where the action is today. Agriculture commodities right here. This is a basket of all of them. It's actually down slightly. And then a basket of all commodities, including oil and metals, has been going up, but it's kind of going sideways right now. So that's what it looks like. Commodities looks like where the action is. Stay tuned and we'll see how things play out, especially at the end of the day today. Watch those levels and I'll talk to you this Monday. Have a great weekend and take care.